Welcome to CMA USA Exam Coach. We're finally kicking off with CMA Part 1, and in this video, we'll take a closer look at the syllabus overview before we dive deep into each section in the upcoming episodes. Part 1 is all about understanding how a business plans, measures, and controls its performance. Basically, how management makes smart financial and operational decisions every single day. The syllabus is divided into 6 key sections, and each section plays an important role in helping you master management accounting. Let's go through them one by one, in simple words. Section A. External Financial Reporting Decisions. This section helps you understand financial statements like the income statement, balance sheet, and cash flow statement, and how to interpret them to make business decisions. Section B. Planning, Budgeting, and Forecasting. Here you'll learn how organizations plan for the future, create budgets, and forecast financial results. It's about setting goals and estimating what might happen next. Section C. Performance Management. This part focuses on measuring how well a company is doing, using tools like variance analysis, KPIs, and performance reports. Section D. Cost Management. In this section, you'll learn about different types of costs, cost behavior, cost allocation, and how managers use cost information for decision-making. Section E. Internal Controls. This covers how companies protect their assets, prevent fraud, and make sure all financial information is accurate and reliable. Section F. Technology and Analytics. This is the newest and most exciting part. It focuses on how technology, data, and analytics are used in modern accounting, including automation, big data, and visualization tools that help in smarter decision-making. In short, Part 1 connects financial information, internal operations, and technology, giving you the complete picture of how a business runs efficiently and ethically. In the next slides, we'll go section by section and discuss what exactly each one covers in detail. Now that you know the overall structure of Part 1, let's begin with Section A, External Financial Reporting Decisions. This section is the foundation of your accounting knowledge. It teaches you how to prepare, understand, and analyze financial statements that are shared with external users, like investors, creditors, and regulators. In simple words, Section A helps you answer one big question. How do businesses report what they own, what they owe, and how much they earn? Let's go through the key topics you'll study in this section, one by one, in a simple, easy-to-understand way. 1. Financial statements. These are the official reports of a company's financial performance and position. You'll learn about the income statement, balance sheet, and cash flow statement, and how they connect to each other. Think of them as a story: what the company earned, what it owns, and how it manages its cash. 2. Accounts receivable. This means money owed to the company by customers who have bought goods or services on credit. You'll learn how to record it, when to recognize bad debts, and how to estimate what portion may not be collected. 3. Investments. Companies often invest in stocks, bonds, or other businesses. You'll study how these investments are classified, short-term or long-term, and how changes in their value affect financial statements. 4. Equity. Equity represents the owner's share of the business, what's left after paying off all liabilities. It includes common stock, retained earnings, and additional paid-in capital. You'll also learn how dividends and share issues affect equity. 5. Inventory. Inventory means goods held for sale. You'll explore different valuation methods like FIFO, LIFO, and weighted average, and see how they impact profit and taxes. 6. Accounts payable. This is the money a company owes to its suppliers for goods or services received. You'll study how to manage payables efficiently to maintain good supplier relationships and manage cash flow. 7. Business combination and consolidation. When one company acquires another, we call it a business combination. Consolidation means combining the financial statements of both companies into one set of reports so that it looks like a single entity. 8. Depreciation. Depreciation is how we spread the cost of an asset, like machinery or buildings, over its useful life. You'll learn methods such as straight line, declining balance, and units of production, and understand how depreciation affects profit. 9. Intangible assets. These are non-physical assets like patents, trademarks, or goodwill. You'll learn how to record, value, and amortize them, and why they're important in measuring a company's long-term value. 10. Warranties. A warranty is a company's promise to repair or replace products if something goes wrong. We record this as a liability because it represents a future obligation to the customer. 11. Leases. A lease is when a company uses an asset without owning it, like renting equipment or property. You'll study both operating leases and finance leases, and how each affects the balance sheet and income statement. 12. Treasury stock. Treasury stock represents a company's own shares that it has bought back from investors. You'll learn why companies do this, such as to boost share value or maintain control, and how it affects equity. 13. US GAAP and IFRS. These are the accounting standards used around the world. GAAP, Generally Accepted Accounting Principles, is used in the United States, while IFRS, International Financial Reporting Standards, is used in many other countries. You'll compare both and understand the key differences in how they report transactions. 14. Contracts and revenue recognition. This topic explains when and how companies recognize revenue from contracts with customers. You'll learn the 5-step model under the revenue recognition standard: identifying the contract, performance obligations, transaction price, allocation, and recognition. So, Section A is a detailed and very important area. It sets the foundation for all other parts of your CMA journey, because every decision in finance, cost management, or planning starts with accurate financial reporting. Now let's move on to Section B of CMA Part 1, Planning, Budgeting, and Forecasting. If Section A was about reporting what already happened in the business, Section B is about preparing for what's going to happen next. Every successful organization needs a clear plan for the future: how much to produce, how much to spend, and what results to expect. This section teaches you how managers use planning and budgeting tools to turn long-term goals into short-term, actionable financial targets. In simple words, planning is about deciding where we're heading, budgeting is about mapping the route, and forecasting is about predicting the road conditions along the way. Let's take a quick overview of what we'll cover in this section. 1. Strategic planning. Strategic planning is all about setting the big picture goals, like increasing market share, launching a new product, or entering a new region. It defines the company's direction and ensures every department is working toward the same purpose. 2. Budgeting. Once the strategy is clear, budgeting helps convert those goals into detailed numbers: how much revenue we expect, what our costs will be, and how much profit we aim for. Budgets give everyone a financial target and help managers monitor performance throughout the year. 3. Forecasting and techniques. Forecasting is about looking ahead using available data. We use past performance and current trends to predict what might happen in the future, like future sales or expenses. This helps businesses make proactive decisions rather than just reacting when problems occur. 4. Learning curve. This is an interesting concept. It tells us that as employees gain experience doing a task, they become faster, more skilled, and more efficient. For example, a new production team may take longer in the first month, but after a few months, they'll produce more in less time, lowering overall costs. 5. Budgeting methodologies. Finally, we'll learn about different approaches to budgeting. Some companies start fresh every year, called zero-based budgeting, while others simply adjust the previous year's figures, known as incremental budgeting. We'll also see how activity-based and rolling budgets work, helping managers keep their plans flexible and realistic. So, Section B focuses on the future. It's all about preparing, predicting, and planning for success. By mastering this area, you'll be able to help management make smarter, data-driven decisions that align with the company's overall goals. Let's move on to Section C, Performance Management. If Section B was about planning for the future, Section C is about checking how well those plans are actually working. In other words, this section focuses on measuring performance, analyzing results, and making improvements, both for the organization and for individual managers. Performance management ensures that all parts of a business are working efficiently toward the same objectives. It's like the feedback loop in a continuous learning system. You plan, you act, you check the results, and then you improve. Let's go through the key areas covered in this section. 1. Variance analysis. Variance analysis is the heart of performance evaluation. Here, we compare what we planned, the budgeted figures, with what actually happened, the actual results. The difference between the two is called a variance. For example, if the company planned to spend $10,000 on materials, but actually spent $12,000, that's a $2,000 unfavorable variance. We'll study different types of variances, such as price variance. Did we pay more or less for materials or labor than expected? Labor variance. Were our workers more or less efficient than planned? Efficiency variance. Did we use resources effectively? Overhead variance. Were our fixed and variable overhead costs controlled properly? Variance analysis helps management identify what went wrong and where improvements are needed. 2. Responsibility centers. A responsibility center is a part of the organization, like a department or division, for which a specific manager is accountable. There are different types: cost centers, revenue centers, profit centers, and investment centers. This system ensures that each manager is responsible only for the things they can control. For example, a factory supervisor may be responsible for production costs, but not for sales revenue. That's why he manages a cost center. 3. Evaluation of managers and business units. This topic focuses on how to assess the performance of both managers and the departments they lead. We look at metrics such as return on investment, ROI, residual income, and economic value added, EVA, to see how effectively managers are using the company's resources to generate profits. It's about fairness and accountability, rewarding good performance and identifying areas for coaching or improvement. 4. Transfer pricing. When one division of a company sells goods or services to another division, the price at which it transfers those goods is called the transfer price. It's important because it affects the profits of both divisions, and therefore, the performance evaluation of each manager. We'll see how companies set fair transfer prices that motivate managers while also reflecting true economic value. 5. Performance measures and the balanced scorecard. Performance isn't just about financial results anymore. Modern organizations also look at non-financial indicators, like customer satisfaction, process efficiency, employee learning, and innovation. The balanced scorecard combines these different perspectives: financial, customer, internal processes, and learning and growth, to give a complete picture of performance. This ensures the company doesn't just focus on short-term profits, but also builds long-term capabilities and customer value. So, in short, Section C teaches you how to measure success, understand variances, and evaluate both people and processes to keep the organization on track. It's about accountability, improvement, and alignment with strategic goals. Let's move forward to Section D, Cost Management. If Section C was about measuring performance, Section D is all about understanding, controlling, and managing costs. In business, every decision, from pricing a product to planning a budget, depends on knowing your true cost. That's why this section forms one of the most practical and powerful parts of your CMA journey. Cost management teaches you how to identify where money is being spent, how efficiently it's being used, and how to reduce waste without harming quality or performance. Let's go step by step through what you'll learn here. Classification of cost. Before we can manage cost, we must first classify it correctly. You'll learn to group costs by behavior: fixed, variable, or mixed; by function, manufacturing, administrative, or selling; and by traceability, direct or indirect. For example, the cost of raw materials is a direct cost, while factory rent is an indirect cost. This classification helps managers plan, analyze, and make informed decisions. Cost measurement. Here we study how to measure cost accurately. That means recording every expense involved in producing goods or delivering services. It includes materials, labor, and overheads. Accurate measurement forms the foundation for everything else: pricing, budgeting, and profitability analysis. Cost of goods manufactured, COGM. This topic shows how we calculate the total cost of producing products during a specific period. We combine direct materials used, direct labor, and manufacturing overhead to find the COGM. It helps us know how efficiently the production process converts inputs into finished goods. Joint products and byproducts. Sometimes a single process produces more than one product. For example, refining crude oil produces petrol, diesel, and kerosene. These are called joint products. We'll learn how to allocate total costs fairly among them so that financial statements remain accurate and decision-making is sound. Next, overhead allocation. Overhead refers to indirect costs such as factory rent, utilities, or supervision. Since these costs can't be directly linked to one product, we need methods to allocate them properly, often based on machine hours, labor hours, or activity usage. A fair allocation ensures that each product carries its correct share of total cost. Next, variable and absorption costing. This topic compares two ways of preparing income statements. In variable costing, only variable manufacturing costs are treated as product costs. In absorption costing, both variable and fixed manufacturing costs are included. Understanding the difference helps management analyze profitability and make internal decisions correctly. Next, activity-based costing, ABC. Activity-based costing is a modern approach that assigns overheads based on the activities that drive costs rather than simple averages. For instance, if one product requires more machine setups, it receives more setup cost. ABC gives a more accurate picture of what each product truly costs and highlights opportunities for efficiency. Next, theory of constraints, TOC. The theory of constraints focuses on identifying the bottleneck, the slowest or most limiting part of a process. By improving that single weak point, the whole system's output increases. This idea teaches managers to focus on what really limits performance instead of trying to improve everything at once. Next, value chain and shared service costs. The value chain concept looks at all the activities, from research to after-sales service, that add value to a product. By analyzing each link in the chain, companies can find ways to reduce cost or increase customer satisfaction. You'll also learn about shared services, where functions like HR or accounting are centralized to save money and improve consistency across departments. So in summary, Section D helps you understand every corner of cost, how it starts, where it flows, and how to manage it smartly. You'll learn to see cost not just as numbers, but as opportunities for efficiency, innovation, and value creation. Section E, Internal Control. This section is one of the most crucial areas in the CMA Part 1 syllabus because it connects directly to good governance, accountability, and risk prevention inside an organization. In simple words, internal control means the policies and procedures that a company puts in place to protect its assets, ensure accuracy in financial reporting, and promote compliance with laws and regulations. It's like the nervous system of a business, quietly working in the background to keep everything running safely and smoothly. Now let's look at the main topics we'll be covering under this section. Governance principles. Governance is all about how a company is directed and controlled. It ensures that management acts in the best interests of shareholders and other stakeholders. You'll learn key principles such as accountability, transparency, fairness, and responsibility. Good governance builds trust among investors, employees, and the public. Next, hierarchy of corporate governance. Corporate governance operates through a structured hierarchy. At the top, you have the board of directors, who provide overall direction and oversight. Below them are management teams responsible for implementing policies and running day-to-day operations. Then come internal auditors, external auditors, and regulators, each playing a unique role in ensuring that the organization remains ethical and compliant. You'll understand how these levels work together to prevent fraud and ensure accountability. Internal control. Now, internal control forms the foundation of this section. Think of it as a system designed to ensure that financial reports are reliable, operations are effective, and laws are being followed. For example, requiring 2 signatures on a payment is a simple internal control that prevents unauthorized transactions. The CMA exam often tests your understanding of internal control frameworks, such as COSO, which stands for Committee of Sponsoring Organizations of the Treadway Commission. Next, control activities. These are the specific actions taken to achieve control objectives. They include things like approvals, reconciliations, verifications, authorizations, and physical security of assets. For instance, comparing bank statements with internal records every month is a control activity that ensures accuracy in cash reporting. Next, audit options. Auditing provides an independent review of the effectiveness of internal controls. Internal audits are done within the organization, while external audits are performed by outside firms. Through this process, weaknesses are identified, recommendations are made, and management can take corrective actions. You'll learn how audit reports help maintain integrity and credibility in financial reporting. Next, system control. With increasing use of technology, companies now depend heavily on computerized systems. System controls are designed to ensure data accuracy, prevent unauthorized access, and protect information from misuse. This includes passwords, access rights, system logs, and automated checks that verify data integrity. Next, internet security. As businesses move online, protecting digital data becomes critical. Internet security refers to all measures taken to protect systems, networks, and data from cyber attacks. This involves firewalls, encryption, multi-factor authentication, and secure data backups. Even a small security failure can lead to major losses or reputation damage, so awareness and preventive measures are key. Next, Business Continuity Plan, BCP. Finally, we'll discuss the Business Continuity Plan, which ensures that an organization can continue operating even when unexpected events occur, like natural disasters, system breakdowns, or cyber attacks. It includes backup systems, recovery procedures, and communication plans to minimize downtime and protect critical operations. So, in summary, Section E is all about protection and preparedness. It helps businesses stay strong, reliable, and trustworthy, no matter what challenges arise. As future CMAs, you'll play a key role in designing and maintaining these control systems, ensuring that the organization stays secure and efficient. Section F, Technology and Analytics, the final and one of the most detailed sections in CMA Part 1. This is a long and technical section, but also one of the most interesting, because it connects accounting, technology, and data analysis together. In today's business world, financial professionals are not just accountants. They are also expected to understand how data flows through systems, how technology supports decision-making, and how to protect that information from risks. Let's go through the key areas we'll be covering in this section one by one. Information systems. Every modern organization depends on an information system to collect, process, and deliver information. These systems make it possible for accountants and managers to access real-time data, monitor performance, and make decisions faster. We'll understand how these systems work and how different departments, like finance, HR, and operations, are linked through technology. Next, transaction cycles. Transaction cycles describe how business activities flow, from sales to cash, or from purchases to payments. For example, the revenue cycle starts when a customer places an order and ends when cash is collected. Similarly, the expenditure cycle involves purchasing goods and paying suppliers. Understanding these cycles helps you track data movement and detect errors or fraud. Next, database. A database is where all business data is stored and managed. Think of it as a digital filing cabinet that organizes information systematically. You'll learn how data is stored, retrieved, and maintained, and why database management is essential for accuracy and security. Next, Enterprise Resource Management, ERP. ERP systems bring all functions of a company, finance, production, HR, supply chain, into one integrated software system. Popular examples include SAP, Oracle, and Microsoft Dynamics. We'll see how ERP systems improve coordination, reduce duplication, and provide accurate data for decision-making. Next, data warehouse. A data warehouse is a large central storage system that collects data from multiple sources within the organization. It allows management to analyze historical data and identify trends. For example, a company might use data from sales, marketing, and finance to forecast future demand. Next, data governance. Data governance refers to the policies and procedures that ensure data is accurate, consistent, and used responsibly. It includes who can access data, how it is protected, and how compliance with regulations like GDPR is maintained. Proper governance helps prevent data misuse and ensures data integrity. Next, data lifecycle. The data lifecycle explains how data moves through stages: creation, storage, usage, sharing, archiving, and deletion. Every stage must be handled carefully to maintain data quality and privacy. For example, customer data must be securely deleted once it's no longer needed to comply with data protection rules. Next, cyber attacks. Technology brings benefits, but also risks. Cyber attacks are deliberate attempts by hackers to access, steal, or damage company information. You'll learn about common types of attacks like phishing, ransomware, and data breaches, and the security measures that protect organizations against them. Next, artificial intelligence, AI. Artificial intelligence is transforming accounting and finance. AI tools can process large amounts of data, detect patterns, and even predict outcomes. For instance, AI can automatically detect unusual transactions or forecast sales trends. We'll explore how AI improves efficiency while still requiring ethical oversight. Next, cloud computing. Cloud computing allows organizations to store and access data over the internet instead of relying on local servers. It provides flexibility, scalability, and cost efficiency, but also requires strict data security controls. Most modern ERP and accounting systems are now cloud-based. Next, data analytics and data mining. These are powerful techniques used to find patterns and insights within large data sets. Data analytics focuses on analyzing data to make business decisions, while data mining digs deeper to discover hidden trends and relationships. You'll learn how accountants use these tools to improve accuracy, detect fraud, and forecast performance. Next, regression analysis. Regression analysis is a statistical tool used to understand the relationship between two or more variables. For example, how sales change with advertising spend or price adjustments. This helps managers make data-driven decisions instead of relying on intuition. Next, data visualization. Data visualization transforms numbers into easy-to-understand charts, graphs, and dashboards. It helps decision-makers see trends and patterns at a glance. Tools like Power BI, Tableau, and Excel are widely used for this purpose. Next, cryptocurrency. Finally, we'll touch on cryptocurrency, a modern digital form of money based on blockchain technology. You'll learn how cryptocurrencies work, why they are considered risky assets, and how they are treated under accounting standards. So, dear students, Section F will help you become a tech-savvy finance professional who can not only interpret financial data, but also understand the systems and technology behind it. This section brings together everything finance, data, technology, and ethics, to prepare you for the future of accounting and management. Dear students, we've now completed our introduction to CMA Part 1, where we got a full overview of all 6 key sections. From external financial reporting decisions in Section A, to planning, budgeting, and forecasting in Section B, then performance management, cost management, internal control, and finally, technology and analytics, which connects accounting with the future world of data and digital transformation. Each of these sections builds your understanding step by step, starting from financial reporting and planning, moving into control and performance, and ending with how technology supports modern finance. CMA Part 1 truly develops you into a complete management professional, someone who not only understands numbers, but can also analyze, plan, and make strategic business decisions ethically and confidently. Remember, dear students, consistency is the key. Make a study schedule, practice multiple choice questions every day, and review the concepts until you can explain them in your own words. Don't just memorize, understand the logic behind each topic. You've already taken a great step by learning systematically with this series. Stay patient, stay motivated, and don't give up, because every topic you learn is bringing you one step closer to your CMA dream. Thank you so much for watching this episode. In our next episode, we'll officially begin Section A, External Financial Reporting Decisions, where we'll start exploring financial statements in detail. So get ready with your notes, practice questions, and most importantly, your focus and determination. See you in the next episode, and as always, keep learning, keep progressing, and believe in yourself.